All right, let's dive right into today's explainer on Welltower, which trades under the ticker symbol WELL. We're looking at a true heavyweight here. It's an S&P 500 company and literally one of the absolute strongest performers in the entire large-cap real estate space. Today, we're going to break down their massive property portfolio, their honestly eye-popping financial metrics, and the unstoppable macro trends driving their growth. But real quick, just a quick reminder before we get going, this explainer is strictly for educational purposes, not financial advice. We're looking at public data as of August 2026. And you know the drill. Past performance doesn't guarantee future results. Okay, let's get into it.
So here's our game plan for today. We've got 6 key areas to cover. We'll start by defining exactly what this healthcare giant does, unpack their recent record earnings, and take a look at a genuinely historic dividend streak. After that, we'll gauge what Wall Street is predicting, weigh the current valuation and risks, and wrap it all up with a massive demographic tailwind that's powering their entire business model.
Starting off with the big picture, let's look at Welltower's blue chip setup. They were founded back in 1970 and are headquartered out of Toledo, Ohio. Fast forward to today, and they operate over 2,500 properties. And they aren't just anywhere. They're concentrated in high-growth markets across the US, Canada, and the UK. Basically, they fund the absolutely crucial real estate infrastructure needed for healthcare delivery. We're talking seniors housing, post-acute care facilities, and outpatient medical buildings.
Now, this is where things get really fascinating. Nearly 95% of Welltower, 94.8% to be exact, is owned by institutional smart money. We are talking about massive hedge funds and major professional money managers. To put that kind of scale into perspective, in August 2026 alone, Danske Bank scooped up over 417,000 shares. That single transaction was valued at roughly $94.7 million. That level of institutional ownership is a massive signal of confidence from the market's biggest players.
And if you want to know what's driving all that confidence, you just have to look at their momentum. Welltower boasts a phenomenal 42.25% gain over the last year alone and a year-to-date jump of almost 27%. As of mid-August 2026, the stock was trading at $235.73, sitting right near the absolute top of its 52-week range. You don't accidentally reach a market cap of nearly $170 billion. That completely cements their status as a heavyweight in the real estate sector.
So let's shift gears and look at the operational side of things, specifically their record-breaking July 2026 results. This is where the rubber meets the road.
In their Q2 2026 report, standard GAAP earnings actually missed expectations just a little bit, coming in at 61 cents per share. But if you follow real estate investment trusts, you know that standard earnings don't really tell the whole story. The metric the market actually cares about is normalized funds from operations, or FFO, because it measures the actual cash generated by the properties. And Welltower's FFO, it surged 25% year over year to $1.60 per diluted share. That is among the highest levels in the company's entire history.
These internal growth metrics are just wildly impressive because they perfectly illustrate Welltower's massive pricing power. Same-store net operating income jumped an incredible 15.5%. And it gets better. They managed to increase their revenue per occupied room by 5.2%, all while keeping their own property operating expenses practically flat at just 0.7% growth. That level of extreme efficiency pushed their operating margins above 32% on a total revenue pool of $3.54 billion.
Management has a name for this wild success. They call it Welltower 3.0. Essentially, it's a strategic shift toward a vertically integrated model that blends their huge real estate footprint with cutting-edge technology and hyper-efficient operations. And it's clearly working. It's working so well, in fact, that it gave management the confidence to raise their full-year 2026 FFO guidance to between $6.36 and $6.44 per share. And get this, that was their second guidance increase of the year.
Now, for the income-focused investors out there, you're going to love this next part. Let's talk about their legendary 55-year dividend streak, which completely aligns with their goal of protecting stockholder capital while paying out reliable cash.
221. That is a staggering number. It represents Welltower's 221st consecutive quarterly cash dividend. We're talking about a track record of absolute consistency stretching back over 55 years. That means they've kept paying through recessions, through market crashes, and even through a global pandemic.
And they aren't just letting that dividend sit there. They are growing it aggressively. In June 2026, the board announced a massive 15% increase. That brings the quarterly payout to 85 cents per share, or $3.40 annualized.
Now sure, the actual dividend yield sits at a relatively modest 1.4%, but that's simply because the stock price itself has appreciated so much. That 15% bump loudly proves their ongoing commitment to rewarding shareholders as their cash flow grows.
With all that operational momentum, what exactly are the professionals expecting to happen next? Let's take a look at the consensus on Wall Street. Honestly, the street is undeniably bullish. Out of 22 analysts polled by S&P Global, 17 rate the stock a buy or a strong buy. Just 4 rate it a hold, and only one single analyst has a sell rating on it. When you average out their numbers, the price target sits right around $255.59, implying about an 11% upside from where it's currently trading.
But if you scratch just below the surface, there is a pretty stark spread in opinions. Bank of America recently reiterated their buy rating and set a street-high target of $292. But on the complete opposite end of the spectrum, Morgan Stanley holds a target of just $215. That is a $77 gap. It highlights a very real tug-of-war among the pros over whether this stock has simply run up too far, too fast.
And that naturally brings us to the catch, because no investment is perfect, right? We need to ruthlessly examine the other side of the coin, the valuation and the risks.
The plain truth is that Welltower is incredibly expensive compared to its REIT peers. A price-to-earnings ratio of around 108 means investors are paying a massive premium today for growth that hasn't happened yet. A price-to-sales ratio of 13.4 is also really steep. Because of these multiples, several financial models actually put the company's fair value estimate right around $228 to $230. With the stock trading up around $235, it means Welltower might already be fully valued or even slightly overvalued right now. Essentially, that premium is already baked into the price.
Beyond just having a steep price tag, there are critical macro threats you have to weigh. First, there's valuation compression and obvious interest rate sensitivity, which dictates their borrowing costs. Then you have external threats, like shifts in healthcare policy and a very real regulatory overhang over in the UK, where their Competition and Markets Authority is actually investigating Welltower's care home acquisitions. There are also execution risks tied to rolling out their new 3.0 technology. And finally, remember that 94.8% institutional ownership? It's great when they're buying, but if those funds suddenly decide to take profits en masse, it would create severe downward pressure on the stock.
Despite those very real threats, though, we have to look at the long-term structural thesis for this company, because it remains undeniably compelling.
Welltower sits squarely at the center of what economists call the silver economy. We are right in the middle of a massive, decades-long demographic shift. Populations all across the developed world are aging rapidly, and the cohort of folks moving into senior communities is enormous and growing every single day. This creates structural, non-cyclical demand for well-run senior housing and healthcare infrastructure across the US, Canada, and the UK. This isn't just some passing fad, it is a permanent shift in human population dynamics, and Welltower is perfectly positioned to capitalize on it.
So to bring it all together, here is the final scorecard. We've got a company executing flawlessly on their operations, with incredible momentum and record Q2 numbers. Wall Street loves them, giving a solid consensus buy. Their dividend is legendary, hitting 221 consecutive payments with a fresh 15% increase. But on the flip side, the valuation is absolutely stretched, trading above fair value estimates, and the overall risk profile is elevated due to those high multiples and the UK regulatory investigations.
As you review all this data and figure out how it fits into your own investment strategy, it really all boils down to one final critical question. Does the unstoppable momentum of the silver economy and Welltower's flawless operational execution justify buying in at this premium valuation today? Think about that for a bit. Thank you so much for joining me for this explainer. I hope this deep dive helped you grasp exactly what is driving this absolute giant in healthcare real estate.